Hey guys, Joel Frank here, market analyst for YouTrading, and in today's video, we're going to be taking a look at a couple of trade ideas that I'm monitoring. There's two that I really like the look of at the moment. Think actually we'll start with the Dixie as opposed to the S&P 500, but yeah, pretty much it is uh, making a bet against the dollar, and I'll show you how I'm looking at playing that with the dollar index. And making a bet in favor of a rally in US stocks in the next couple of weeks. So yeah, let's look first at the dollar. You can see here that on Thursday, it's broken convincingly below its 200-day moving average. It's broken below those November lows as well. And it looks like it's about to test this low here from, when was that low printed actually? I can't see. August. Yeah. Why are we selling off? Well, in the last couple of weeks, there's been convincing evidence out of the US that inflation has peaked and is coming back to the Fed's target a little bit faster than expected. That's led to an easing of concerns about how aggressive the Fed's going to have to get in 2023 with further interest rate hikes. Now, yesterday we had Fed Chair Powell speaking, and markets. I mean, it was pretty much what I was expecting. Like he said that they're going to slow the pace of interest rate hikes to 50 basis points at the Fed meeting coming up on the 14th of December. Um, but they're still going to have to do substantially more interest rate hikes, which is pretty much what most people were expecting. But I think his tone, the market seemed to interpret as dovishly. So that weighed on the dollar index. And then we're coming under a little bit further pressure today. Let me just show you the economic calendar and I'll show you why. The core PCE price index, the month over month reading came in a little bit softer than expected. So it's another downside inflation surprise. And remember, this core PCE price index is actually the Fed's favored gauge. And by the way, if you record 0.2% month over month price increases for a whole year, which is what we got in October, according to this index, then that actually gives you an inflation rate of just a little bit over 2%. So actually, the monthly inflation rate in October was at the Fed's target. It's just the year over year is still way above. So anyway, easing of inflation concerns, easing of Fed tightening concerns. Seems as though the peak Fed hawkishness has been and gone. Um, if I get this on a 4 hour, let me just mute those now. You can see that we kind of formed a bit of an ascending triangle, um, which means that there's probably a bit of technical selling at play here as well. Yeah, you can see we had a bit of an ascending triangle, but we've broken below it. I think the next stop is to probably test that August low. Then if we get any rebound to this 105 area once again, um, that is when I will be looking to potentially add to short positions and then target a longer move lower. And if I just take you back to the 1 day candlesticks, we can have a look at some of those downside targets that I'll be looking at. Um, yeah, this August low's around here. I think eventually, if the Fed really is, we have really come to peak hawkishness, um, we could eventually fall all the way to 101 in the Dixie. But you can see on the RSI that we're not oversold yet, which means I think we could get a bit further downside in the next couple of days or weeks. But eventually we're going to break, if we do break into this sort of range here, you would expect to see some consolidation and maybe a bit of a rebound. I'm not expecting a rapid drop to this level pretty much is what I'm saying. But we're going to have to wait and see how things shake out. Stocks, like I was saying, this is the other thing I'm watching at the moment. Um, Yesterday's dovish reaction to Powell's speech. We saw another big intraday gain of about 3.3%. That's a big gain, but remember we had that 5.5 or more than 5.5% gain earlier this month on the downside inflation surprise. So I think if the data continues to point in the right direction, and the Fed continues to get a little bit less hawkish, we could be seeing a few more of these big day gains in the coming weeks. But anyway, talking more technically, we've broken above this range that we were recently in. Importantly, we've broken above the 200-day moving average there, which you can see in green. This is the first time we've mustered a sustained break above that level since, going all the way back to sort of March and April, really. Although that March rally above the 200-day moving average did just prove to be a false. a false recovery. Do I think it's going to be a false recovery this time? Probably not, because of all the fundamentals that I've just been talking about with inflation improving. We've got the next inflation data out of the US. When is it actually? It's the November CPI. November PPI is out next Friday. And then November CPI must be out, yeah, on the 13th, the day ahead of the Fed meeting. So that week, not next week. I mean, next week's going to be important. But the week after, that's going to be huge. CPI and then Fed meeting, two potential big catalysts for stocks. And I could think that just as we've seen in November, where the CPI sent stocks higher and then Powell sent stocks higher, CPI could again send stocks higher, and the Fed meeting could again send stocks higher. We're going to have to wait and see. But the trend is certainly pointing upwards. I mean, actually, I didn't really notice this before, but you could probably make an argument that we're in a bit of an uptrend here, or an upward sort of trend channel. You could make an argument that we're sort of, it's not exact, it's not completely perfect, but you could make an argument that we're in that kind of upwards trend channel. But anyway, my idea with stocks now would be to buy any dips back to the 200-day moving average and back to that previous November highs. And then target a move first of all to this September high, which is around 4,150, and then on to this August high. This is all on the potential easing of financial conditions. One thing to note though is that it is looking more and more likely that we're going to get a US recession, which a lot of people think could potentially be bad for stocks. If the easing of financial conditions as a result of the recession isn't sufficient. I think it probably will be sufficient. Like if we do get a 2023 recession, I think that that's going to mean a big drop in inflation and a big pivot from the Fed, which would probably, I think that would probably be enough to send us back to all-time highs by the end of next year. But we're going to have to wait and see about that. But yeah, guys, that's pretty much what I'm watching at the moment. Hope you enjoyed the video. Hope you all found it informative, and I'll see you all in the next one.